Hey everyone, thanks for joining me in this one. In this video, I'm going to be doing a stock portfolio update of my $212,000 Wealthsimple portfolio. I'm going to go through the positions I have in my portfolio. I'm also going to talk about what stocks I'm interested in, talking about some of the stocks in my portfolio that have been trending down, just giving my general thoughts on some of the moves in the market and how it's impacted my portfolio. So if you like this kind of content, be sure to hit the subscribe button on my channel. Also, it would be great if you hit the thumbs up button for the YouTube algorithm, but we'll just jump right into it. So as you can see on the screen here, the majority of my $212,000 portfolio is in Canadian stocks here, about $130,000. Going back about 3 months before getting into any individual stocks, my portfolio's been hit pretty hard, down over $4,000 in the last 3 months here. It's been a lot of drivers of this. The overall market has just been a bit softer as of late, but also some of the areas that I invest in more notably have been hit harder. Just doing a longer term analysis here, in the last 12 months, I'm still down about 1%. So it hasn't been a great year for me. And then all time, which is I think about 2.5 years, only up 3% on the Canadian side. So could have been worse. 2.5 years ago, lots of stocks were high flyers. Lots of stocks are down 70, 80, 90%. I don't really get involved in the more speculative stocks, so I wasn't hit from that, but still not tremendous returns on the Canadian side over the last few years. So getting into some of the stocks that I own, one of the reasons, as I just scanned through here before going on any individual stock, just talking general themes, one of the reasons that my portfolio has been trending down the last few months has been real estate. So you see Allied here down 25% all time, CapREIT here down 5%, continuing to go down. Northwest Healthcare down huge. This stock's down the most any stock's been in my portfolio. Any of my portfolios down 47%. So real estate has really hit the valuation of my portfolio here. To be honest, I don't get too fixated on valuations just because I don't really plan on selling any of my positions anytime soon, as long as the fundamental underlying business is still doing well, which in some cases isn't what's happening like on Northwest Healthcare. But Allied Properties is one that I think the risk reward is still really good on. They do about $2.30 of funds from operations, so currently trading at about 9 times funds from operations. Looking at the stock in the last year here, down over 33%. As I look at their dividend yield, trading over 8.5% yield. So they're trading at 9 times FFO, so yielding on the company about 11%, give or take, giving me 8.5% of it, reinvesting the remainder, hopefully paying down debt. But a couple of the reasons why Allied is more notably hit than other REITs is just their office exposure. Some people are concerned that banks won't want to lend to them when their current mortgages or line of credits come due, and they may have to pay higher rates to attract that debt that they need to run their business. So that paired with some of the sentiment around not everyone returning back to office, people cutting office space, is really like a double squeeze from both sides on Allied's business here. My thoughts on it and why I still hold it, I think it's definitely a volatile one, maybe a bit more risky than my average dividend stock. But I think that they own properties in really good locations. They own a ton of downtown Toronto on King Street and whatnot, big portions of the downtown core in Montreal, in Vancouver, big metropolitan cities. And they have a ton of opportunities to build up lots of their space. Even in Toronto, lots of their locations are 5 stories, 6 stories. But if you look around them, there's these huge office towers. Now, obviously, they need office demand to eventually come back if they want to continue to be primarily an office REIT. But I think the underlying intrinsic value of lots of their assets is really high based off the location that they're in. And if it went to the open market, you cannot buy downtown Toronto real estate, even if it's office, with like an 11% cap rate or anything like that. So I think that this has been punished way too much. Their net asset value is still in the 50s, so they're trading at under half their net asset value. And I think when interest rates or if interest rates trend down, demand stabilizes for return to office and whatnot as more businesses migrate to Toronto as a growth city, we will see Allied Properties do just fine and their stock correct, in my opinion, to some extent. In the meantime, getting paid over 8.5% to wait on this one. So some may disagree on this one, which is fine, but it's one that I've been invested in for a while. Their funds from operation has not dropped at all since before COVID, yet the stock price is down huge. So just paying a 9 times multiple instead of a 25 times multiple is fine for me as a long-time shareholder. I have a couple royalty funds as well that have been dipping a bit recently, but holding up decently. A&W Royalty Corp's one that I have a pretty good position in of $13,000. The other one that I'll talk a bit more about, since I usually talk about A&W, is the KEG Royalty Income Fund. So the KEG here, as I look over the last year, the stock's down 5%, but I've gotten about 8% in yield from it. So up a few percent, nothing huge. I think it's trending down as some macro indicators may suggest consumers are becoming under more and more pressure. And unlike a royalty corp like Pizza, which I own in another portfolio, or A&W, which is more like grab and go, cheaper food, the KEG is more expensive and it's sit down. So it's more concerns on them losing demand and volume not necessarily trading down into them in the case of some economic pressures. So the multiple is expanding in terms, or detracting in terms of the valuation of these streams of royalties. But once again, owning for the long term, I think the KEG will continue to pay me my monthly dividend. And I love the starting yield of almost 8% here. So going to continue to hold this. I built this up recently to about 100 shares in this account. I own more of it in a few other accounts, but not one that I'm looking to build a lot higher right now. I have other investment priorities within my portfolio, but definitely not one that I'm not scared to hold through some volatility. And also, if it continues to trend down, if I start getting even higher yield, I may have to relook at it in terms of investment decision. Now, I want to touch on a decision I've made on lots of my covered calls. So I own a lot of covered calls in my accounts. Here's a couple of them here. Life, which is a covered call on global healthcare companies. Think businesses like Pfizer, GSK, etc. This one I'm down about 4% on, getting a 9% dividend yield. Another few that I own up here are Huddle, which is global utilities. This one I'm down about 9% on, getting about a 9% dividend yield. And then lastly, in this portfolio, I own HDIF, which is a collection of different covered call ETFs. This one pays a huge dividend, about 11% here, down about 6% on it. So in addition to these, I also own ZWB, ZWC, a couple other ones in other accounts. But I actually have not bought any shares in any of these covered call ETFs for a handful of months, and I have no desire to build up my covered call ETF positions in the near future. I think there's great opportunities in straight equities. A couple of reasons I don't love being overexposed to covered call ETFs. A couple of reasons would be, one, management fees are very high. You're typically paying 0.7, 0.8%. I think they do serve a purpose. In my portfolio, I do love the very high monthly income that I get. I usually take the couple $100 a month from these covered call ETFs, and I'll invest in one of the growth stocks that I'm looking at building up, dividend growth stock within my Wealthsimple portfolio. So it acts as a source of capital, which I really like, but I really don't want to get overexposed to these because long term, they're not overly tax efficient. They have high management fees, and they're not really positioned for capital appreciation. So I do love getting those 9% yields, but it kind of gets diluted when you go down and you see the stocks down 4, 5, 6, 7, 8%. It really wipes out lots of the gains. So that's one of the things, being an investor still in my late 20s, I think in terms of a core position in covered call ETFs, probably better spaces to be. But I do really like having these niche positions where I am getting paid 50, 70, $100 from each of these ETFs, just as a source of more capital to go after those other priorities that I have in my portfolio and to really help my monthly income on a small part of my portfolio. Looking at a couple other smaller positions here. Jameson Wellness has been one that I recently entered, and it's just been trending down and down and down since I entered it. Stock's down over 30% on the year. They did lower their guidance once or twice, which I think you see actualized here from 30 down to $27, but they're still expected to do about $1.60 in EPS. So trading at about 15, 16 times earnings for a company that has historically grown their top line and bottom line really nicely, has increased their dividend every year since becoming public, currently paying out close to a 3% dividend yield, trading at about $1 billion valuation. They have free cash flow of $80 to $90 billion. So trading at about 12 times free cash flow, 15 times EPS. I think the risk reward for this company is good. So I'm continuing to average into it up to 40 shares, looking to continue to buy more as long as it stays at these relatively low levels, in my opinion, at least. One of the great things about Jameson is it's a Canadian company, and it's really hard to get these consumer packaged good stocks on the TSX. Usually you have to pay the FX fee to go to the U.S. to buy Clorox, Coca-Cola, PepsiCo, and whatnot. But you actually get to buy Jameson Wellness in our own currency here in Canada. You get global diversification to a certain extent. They have a U.S. business. They have a China business. They're growing in some other markets as well. And you get that 3% dividend yield without having to pay any U.S. taxes or other tax complexities on it. So I like how the stock's on the TSX, pays a nice dividend in Canadian dollars. Don't have to worry about all the fees that come along with owning international stocks if you're a Canadian citizen. And the valuation is significantly cheaper than lots of those other CPG companies in the US and that are traded on other exchanges in international markets. So this is one that hopefully it stays down here and the business fundamentally continues to perform well. And I'll look to continue to build this into a bit of a bigger position on my end. QSR, or Restaurant Brands International, is a stock that has actually been trending down over the last month. It's one of the reasons my overall portfolio hasn't been doing too well, down over 7% here. I haven't seen any notable news. I know they reported earnings a while ago that looked like they came in line with expectations, even some beats in some respects. So was surprised to see the stock trending down. It has been on a hell of a run the last year, still up 18%, but they're expected to do about $4.50 in EPS in the next 12 months. So that puts them trading at about a 20 times, 21 times earnings. Compare that to some of their competitors like McDonald's, Yum Brands, who trade at 25, 26. I still think RBI, or Restaurant Brands International, is positioned really well and in a good place here at these valuations. I haven't really been buying recently because I'm up pretty heavily on the stock still, up 22% here. But it's one that I'm definitely watching. If it dips under 80, gets under a 20 forward PE, maybe an interesting build in the quick service restaurant space. And for those of you who don't know, Restaurant Brands International owns Burger King. They own Popeyes. They also own Tim Hortons. So some really good brands under their company there. Continuing to go down here, Rogers Communication has gotten hit as well. As I go through, it's lots of reasons why my portfolio is down over the last 3 months, but Rogers is another one here, down 6%. They reported their earnings. I didn't think their earnings were bad. I think there's just a bit of a mess still. Lots of debt from their Shaw acquisition that they closed on here recently. So just looking to see how that pans out over time and how they're able to pay off that debt and integrate Shaw to drive revenues and disproportionate EPS. Looking here at their dividend yield, trading at about a 3.7% yield, PE trailing at about 18 times. So this is one that they do have some exposure to, like cable, but cable hasn't really been as big of a decelerator in Canada as it has in the US. They also have the number one wireless business in Canada, which is a great source of revenue and profit. And they own a lot of media assets as well, like the Toronto Blue Jays, a percentage of Maple Leaf Sports Entertainment, and whatnot. So still like holding this one in my portfolio. Haven't bought it for a while. Probably won't. I really want to see how they digest Shaw Communications into the company, unless the stock gets to a silly valuation, in my opinion. And then just some ETFs. I added this new ETF It's just a TSX composite essentially, $32 a share. They pay they charge a really low management fee, just 6 basis points a year. So that's one of the things I really liked. Similar to why one of the reasons or hesitations to having covered call ETFs is too big a component of my portfolio. So I'm paying 0.6, 0.7, 0.75% management fees. I really like how this ETF here charges me just 0.06%. Makes it really easy, and I don't really have to think about the fee. It's under 0.1% a year. And I'm getting a nice dividend yield of about 3.2% on the entire Canadian market. And this just helps me diversify out my entire Canadian holdings. I'm overdeveloped on banks. I'm overdeveloped on real estate. I don't really have energy. I don't really have Canadian retail to a great extent other than the real estate that I own. So this just helps me diversify out my Canadian holdings. Do I expect it to double in a year? No, but I think it'll probably be more stable than my overall Canadian portfolio. Looking at how much I have in this one, just 20 shares. So just recently started building this one out. Would love to get this one up to 100, 150, 200 shares in the coming months. And then lastly, some other ETFs. ZDI is an international ETF that owns lots of stocks in Europe, in Japan, some in Australia. So it gives me some diversification geographically within a Canadian ticker and Canadian dividend. Getting paid over 4%, pays a monthly dividend yield. So really like that one, up about 12% there, which is nice. And then ZQQ, recently bought into this one. It's just a NASDAQ 100 hedged account here. This one I've actually sold a bit of what I bought just as it ran up over the last month, last couple months, about 5% in the last 3 months. As my overall portfolio dropped, I kind of sourced some gains from ZQQ to double down on some other stocks that I've been buying recently. So that's the Canadian side of my portfolio, just some of the stocks I own, some of the reasons you can see as we went through some of those stocks that were down, whether it be Restaurant Brands International, Rogers, my REITs, that have really driven the performance of my portfolio down $4,000 in the last 3 months. So, as a long-term investor, not too fussed by those moves one year to another. I trust the companies that I'm investing in. That's why I invested in them. And I think long-term, they'll continue to do well. And hopefully, as long as their fundamental businesses hold up, any dips will be long-term buying opportunities for me to buy in at lower prices. Going over into my U.S. account here, I have $60,000 US in this account, up about 17% in the last year here. So my U.S. portfolio has saved my investment account for the year, has more than offset all of the hurt on the Canadian side, up $8,500 US here in the last year. Last 3 months, still up about 2%. So some nice offsetting of my Canadian portfolio. Looking at what's been working here. So a couple stocks here. Google's been doing really well for me. I have about an $8,000 position there, 18% of, or 18% gain rather on that one. One stock that hasn't been doing as well, Coca-Cola. I started averaging into this one earlier in the year. Built a pretty big position here, almost $10,000 US, and it has been dipping a bit over the last month, down 4% in the last month alone here, which obviously isn't great. So this is one that long-term I think will do well. It's done really well over the long term, currently paying me a 3% dividend yield, $250 billion market cap, 24 times PE. They have a really good global market position. One of the reasons I went into this CPG company was because of their presence outside of North America. It's about half their business. And I really liked having that diversification on a business that had a lot of pricing power, wasn't overly luxurious or something that would get hit huge in a recession. So I think it's relatively defensive. And I like the brands they own. I think they'll continue to do what they've done over the last few decades into the future, which over time should serve shareholders pretty well. McDonald's, similar type of stock to Coca-Cola, but this one much different story, up 21% in McDonald's, despite it being a pretty small position in this account. And then it comes to the stock I'm up the most in my Wealthsimple account. I am up 185% on Meta. It's been stalling even in the last month. As all these other companies have been dragging me down. I'm looking at Meta to keep the run going, but I'm down about 4.5% over the last month. You can kind of see the stock just went on a huge run up to 325, all the way from 90 bucks earlier in the past 12 months. It's gone down about 10% here, back to 300-ish, but overall can't complain. Lots of reasons why Meta's been on this roller coaster that I won't get into for the sake of time. But overall, still holding my Meta shares in this account. Talking about real estate on the Canadian side, I'd say similar sentiment on the U.S. side. Realty Income was a recent ad. I liked buying into Realty Income as a Canadian because while I have a lot of Canadian REITs, I didn't really have too much exposure to real estate outside of Canada. So Realty Income gives me exposure across every state in the U.S. and also about 15% of their businesses in the UK, Italy, and Spain. So I'm getting some European property ownership as well through this REIT. Now, what's not great is despite paying a 5.5% dividend, the tax rules on U.S. dividend stocks for Canadians are not advantageous, especially when you're dealing with high-yielding companies, because it's usually about a 15% notwithstanding tax goes back to the U.S. government. So out of that 5.5%, about 0.75, give or take, gets taken off right off the top of it, unfortunately, and that's just the cost you pay to own diversified stocks and the cost you pay to buy stocks outside of your country that are paying high dividends. So definitely not a stock that I think I'm going to turn into like a top 5 position or something, but I do have about 8,800 bucks in this account, and it has been trending down. So I have been looking at potentially thinking about buying more, down 6.5% in the last month, as people aren't really sure what's going to be happening with interest rates and if they're going to keep holding for longer or potentially going up. Down 10% in the last 3 months. So I'm down closer to the 10% number, of course, down about 900 bucks. My average price here is about $60 and it's currently at 55. So some work to do for me to get back to where I was on this one. But I do, at the end of the day, really like owning this diversification in my account. Makes me sleep better at night, knowing that I own a REIT that's diversified, not just in Canada like my other REITs, but one that's more notably diversified across the US and into Europe as well. Going into some of my other US holdings here, P&G, similar story to Coca-Cola and McDonald's there. I've held it for a bit longer than Coke, so you see I'm up 14%. S&P Global was a relatively new stock that I bought into. Currently have about $2,000 US in it, and I'm about flat on the position. I really like their credit rating business. Feel like it's very defensive no matter what the economic climate. There'll always be demand for that, and they're pretty much in a duopoly with Moody's. I also like their index business. Anytime anyone buys an S&P 500 or an S&P ETF, they're getting a very small percentage of the management fees, whether that's 1 basis point, 2 basis point, not exactly sure, but I think that's a really great recurring stream of profitability coming back to S&P that I like. So those are the two elements of that business that I like. They also have a data management and data intelligence business that I'm a bit less familiar with, but overall, this one is up about 8% in the last year, 90% in the last 5. So it has been ripping up. So I'm going to be careful in how fast I average into it. But I do think they do have some great competitive advantages. And despite being richly priced, they have some good reasons to be priced at, this is a crazy trailing PE, but I think their future PE is closer to the high 20s. So I think they do have a lot of attributes that make them worth paying that multiple, or I wouldn't be in it. And then a couple other ETFs or stocks rather worth talking. Visa is one of my favorite stocks. I'm so upset it's been ripping up so aggressively over the last little bit here, up 23% in the last year. But Visa is a tremendous business, essentially a toll booth on the global economy. You're getting royalty payments on every transaction, essentially, that goes through their system, and that's constantly happening all around the world. They have a ton of drivers of incremental card usage as cash gets converted into card in new countries. A lot of added services they're working on. I think this is going to continue to build, and their business is going to continue to compound, similar to how we've seen it over the last 5 and last 10 years, which has been just huge amounts of shareholder value. The only thing that can get in the Visa's way, and the only thing, this isn't like a top 3, top 4 holding for me, is I'm worried about regulation. European regulation, regulators there are all over the place and tend to be very aggressive. It's even being talked in the U.S. better regulating Visa and MasterCard. I think there are some fundamental issues on how the U.S. is thinking about regulating them, and it just doesn't really make logical sense. So I don't know if they're going to do something that doesn't make sense, is detrimental to the companies, to consumers. So just whenever companies that you're in or spaces that your stocks play in are under regulatory scrutiny, it kind of gives you pause before going in a big way. That being said, I still have about a $10,000 position in this account alone, up about 17%. I do get a small dividend here, trading at a $500 billion market cap. The dividend yield's gone up, or the dividend payment's gone up year over year since owning the stock. They usually give you a pretty nice raise, even though it's a small dividend to begin with, but like a 10-20% absolute dividend raise. And then the other ETF I very recently added to my account was VXUS. This is a total market ETF. So it owns ETFs that summarize countries like India stock market, China stock market, South American stock market, Australia, across Europe, etc. The only country that it does not have exposure to is the United States. So it's a international minus US market ETF, which I really like because I already have a lot of exposure into the US. And when you have the US in these ETFs, it really monopolizes the weighting because it's such a big market, it's such a big economy. So I really like being able to get access to all those other markets in the world without them being diluted by the US. So looking at building this into a bigger position too, currently only 14 shares, just started buying into it really. They also pay about a 3% dividend yield, which is nice as well. So that's some of what I've been up to in my account over the last few weeks since I've done an update. Let me know in the comments your thoughts on any of the stocks I touched on, or anything that you're buying or selling in your portfolios. Would love to hear from you. If you like this kind of content, be sure to give me a big thumbs up as well, and I will see you guys in the next one. Thanks.